What is EPS? Why is it important? And why should we pay attention to it? I'm sure these questions have crossed your mind at least 100 times, but you still haven't fully grasped it. By the end of this video, you'll have no questions left about EPS, and I'll explain everything clearly and precisely. First, let me note that over the past few months, I've shared analyses of dozens of different and new companies on this channel, and most of them have risen by hundreds of percent in just a few months. Alongside this, I want to continue the series we started a while ago by occasionally making videos like this to help you grow in the investment field and turn you into a professional investor. I recommend checking out the playlist on my channel and watching the videos in order to deepen your investment knowledge completely. So, let's dive in and see what this EPS thing is all about. If we explain EPS in simple terms, it's a metric we get by dividing a company's total net profit by the number of shares circulating in the market. This metric shows how much profit each share generates for the company. For example, if a company's net profit is $10 million and it has 5 million shares in circulation, we divide 10 million by 5 million and get $2. This means the company earns $2 of profit for each share in the market. For instance, in Apple's last financial year of 2024, its net profit was approximately $97 billion, and the number of shares in circulation during that period was around 15.6 billion. So, each Apple share generated about $6.2 in profit annually. This figure is a very important signal for investors. EPS, or earnings per share, is one of the key metrics investors use to measure a company's earning power. A company might generate huge profits overall, but what matters to investors is how much profit each share brings in. EPS directly answers that question. That's why investors first look at EPS to evaluate a company's real profit potential. A high and rising EPS usually indicates that the company is steadily growing and creating value for shareholders. On the other hand, if EPS starts to decline, it shows either that profits are falling or that the number of shares has increased, diluting the earnings. For this reason, EPS is a strong signal for tracking a company's financial health. EPS also serves as a foundation for other metrics. For example, the famous PE ratio is calculated by dividing the share price by EPS. This means you can't conduct a PE analysis without EPS. Investors also widely use EPS when comparing several companies in the same sector. Another reason is that EPS is linked to a company's future dividends. As profits and EPS increase, the likelihood of higher dividends grows, which is a very attractive factor for long-term shareholders. Ultimately, EPS is not just a number, it's one of the clearest indicators of a company's value, growth potential, and profit for investors. That's why experienced and professional investors in the market always pay attention to EPS levels and how they change over time. However, there's a very important golden rule to keep in mind when tracking EPS, one that world-renowned investors like Warren Buffett approach with great care. I'll explain this rule shortly, but first, let me remind you that my goal is to reach 500 subscribers by the end of September. If you found this video helpful, please subscribe to my channel so we can reach 500 together. Now, let's move on to that golden rule. Buffett believes that if a company's EPS is increasing, but that increase comes from borrowing money or share buybacks, it's not entirely healthy. The key is that EPS growth should come from the company's actual business operations. In other words, Buffett is trying to explain that in some cases, a company's EPS might increase, or rather, appear to increase, but there's no real value behind it, just corporate manipulation. For example, a company might buy back its own shares to reduce the number of shares in circulation, artificially inflating EPS. Because when the profit remains the same but the number of shares decreases, dividing the profit by fewer shares makes EPS appear higher artificially. Let's explain this with an example. If a company's profit is $100 and it has 100 shares, dividing 100 by 100 gives us $1, so EPS is $1. But if the company buys back 50 of its shares, leaving 50 shares, dividing the $100 profit by the remaining 50 shares gives us an artificially inflated EPS of $2. EPS rises from $1 to $2, but it's artificial. Almost all world-famous investors are well aware of this manipulation, so when examining EPS, they pay special attention to whether it's based on real value. For example, renowned investor Peter Lynch shares this view. He advises that EPS growth doesn't always mean real growth. Companies might artificially boost EPS through share buybacks to mislead investors. But what particularly catches my attention is the approach of Benjamin Graham, considered the father of value investing. According According to Graham, looking at the EPS trend is a more accurate approach. Because a company might show high EPS in 1 year by chance or through manipulation, what matters to investors is a steady growth trend over 5 to 10 years. If a company has consistently increased its EPS in a real way over the past few years, you can expect potential from that company moving forward. Generally, it's not just me. Many analysts emphasize that EPS alone isn't enough. It should always be analyzed alongside the PE ratio, free cash flow, other profitability margins, and so on. I'll explain these terms one by one in the continuation of this series and add them to my Stock Market Lessons playlist on my channel. Don't forget to check out that playlist and watch the videos I've shared previously in order to boost your knowledge in this field. If you have any additional questions, I'd love to chat with valuable investors like you in the video's comments and respond to all your feedback. Also, I've pinned the link to our WhatsApp channel, where we share daily posts, in the comments. Be sure to join.